Today, folks, I'm going to explain to you why I'm done buying stocks. Over the last month, I've arguably done more trades in my portfolios than I've done arguably in the last 3 years. And since the beginning of the year, doing these weighted adjustments to kind of just diversify myself a little more, I think it's put a gleam in the bank's eyes being like, oh my God, we're getting rich off this kid because I am paying $10 commissions on every buy and every sell. Unfortunately, on the Canadian side of the border, we don't have the same luxuries of commission-free trading. We're getting there with things like Wealthsimple, but they still have some perks that aren't that great, and it's why I won't use them. It's a conversation for another day. I'm just throwing it out there for those people that always comment, why don't you use Wealthsimple or something? But anyways, putting that aside, folks, I want to take a broader view of, are we bottoming in these markets right now? And I want to talk about the US market, the Canadian market. I want to talk about the Shanghai market, general stocks within these markets that I'm very interested in right now. And then I'm going to explain to you what I'm just generally doing moving forward. If that is a conversation you can appreciate, because we're looking at dividend stocks, growth stocks, this should be a fun video for everybody. Hit that like button, folks, because I'm sure you, as I, have been feeling pretty good over the last few days, finally seeing green just straight across the board. Like, it feels like over the last couple weeks here, you could have threw a dart at the board and you wouldn't really be losing money on anything. Bitcoin, the indexes, I mean, Canadian side of the border, the Chinese side of the border. It's just, we're finally seeing what could potentially be some light at the end of the tunnel, but I would take this with a grain of salt and just be cautious because the geopolitical events are still working themselves out, and God knows inflation isn't guaranteed, even though the Jerome Powell gave us some really enlightening news saying that he doesn't foresee a recession, but they just don't know. And obviously Jay Powell's been highly wrong in the past with how transitory inflation's been, so you don't know how much you can trust his words, but it is offering some solace to the general markets, giving us some upside here. So let's talk about the S&P 500, the Vanguard S&P 500 index of VOO, which off its lows, guys, is now trading up 5.63%, finally going back above some recent highs that it hit there before selling off to new lows, which feels pretty good. So let's talk about, are we at a bottom? Well, we do have some signs of bottomings. We're not there just yet, but taking a look at the general price to earnings of the entire market here, we hit highs of like 35 to 40, which was clearly overvalued territory. Now we're back down to a 25 general PE, but keep in mind the median PE has been around 15. I don't know if we're going to get back to a 15, but generally if the market's flatline from here and we still see some good revenue growth out of these large caps, the PE is going to continue to come down from here. So we could see somewhat of just a capitulation here and just people kind of redirecting, sitting patiently, letting the market catch up to its value. And that's something that I think we could see for the rest of the year, which is what a lot of people have been talking about. And another sign of a bottoming to me is obviously the FINRA statistics behind margin use. So these are people leveraging capital into the stock market. And you might recall, if we went back to last year, guys, when people were overzealous, I mean, we hit $935 billion in margin in the markets. To today, where we only really see about $835 billion, but it is picking off the January low. So that means there is some comfortability for people to be leveraging into this market, which is very intriguing to me. So that could be a sign of a bottoming. People happy using leverages, no margin calls anymore, perhaps. Now, my biggest fear still remains the same that I said pretty much since the beginning of this sell-off. Apple did not post revenue guidance. When Facebook and Amazon posted single-digit revenue guidance for 2022, they immediately sold off like 20-30% to the downside with something like Facebook. Apple, however, has been grazing through this by not offering guidance, and I really would be patient with this. If you don't own it, it's a great time to start buying, in my opinion, but because I have exposure, I'm really worried that they're, when Q1 hits, if they miss any kind of revenue expectations that people are predicting, this thing has the real capability to still fall off a cliff, because it is still insanely valued for a company that at its scale will not be growing at double-digit growth rates. It's going to be losing that over time, in my opinion. So Apple is one I'd be cautious with. Microsoft, of course, but again, this is coming from somebody that has some of his largest positions in these two stocks. Just my 2 cents there, guys. So I'm being patient and I'm going to wait for Q1 earnings. Now, when we're talking about growth stocks that I would love to see finally bottom, so perhaps I can take a risk on investment in them, Shopify, man. I've been eyeballing Shopify for so long here, guys, and I don't know if this is an exact bottom based off this insanely downwarded chart. It could potentially be, but I don't know yet. Even jumping up 30%, it's still down 50% on the year here, but these are ones that I'm still going to follow the story on and just see how this rolls out. Same with something like Tesla. Like, these are the kind of companies, guys, whether we're talking Shopify, Tesla, I'm going to put Tesla kind of in the speculative basket over Shopify because I could see how you'd value Shopify here. But Tesla right now is one of those companies where there's still a lot of polarization around it, with people hating it, people loving it. I'd arguably say the fair value price on this is way down closer to $300 or $400 a share, and even that's still at a premium. But obviously, guys, if you're going to own a company like this, people keep asking me, well, where do you buy in? You just buy it. You don't care about what you're paying, and then don't look at it for 10 years. I kept saying that about Google. I said that about all these large caps, that if you don't have exposure and you're buying them, you better be buying them for the next 5 to 10 years, because God knows these are well valued in, right? But luckily, I'm expecting Tesla to post just gangbuster earnings here. They're raising the prices of their vehicles because costs are going up, but their margins are phenomenal. They have so much pricing power because the demand has pushed the Model Y out to the summer of this year, so you can't even get a Tesla vehicle right now. So I'm expecting earnings to be very good from this company, but again, the earnings can't really reflect onto the stock price in any material way other than hype. It is a hype stock. So coming over to the Canadian side of the border, let's talk about the TSX here, guys. So the Canadian border has been outperforming the US side of the border. We're up 2.27% thanks to some unbelievable growth out of some very boring companies. And my Rio clan, hashtag Rio clan, I love you guys because Rio clan has basically been making me rich. It's the largest position in my portfolio right now, guys. And when we were buying this from $14 to $17 a share, capping in a 6% dividend yield, if we get that 6% yield, plus this thing stays at 13 to 14% cap gains, damn, we just made 20% on the year. So the Canadian real estate market has just been unreal. The financial market definitely outperforming the US financials. JP Morgan right now is trading down, but Bank of Nova Scotia is holding up almost 2% on the year with a 4% dividend yield. My biggest fear with the Canadian financials, however, is if the Canadian real estate market isn't a bubble and we start seeing anytime within the next 2, 3, 5 years a downside risk to that, the banks will inevitably be hit because obviously Canada is largely leveraged off real estate and so are the banks. Now, on the energy side of it, I love the Canadian markets, man. This has been like the hideout for capital, in my opinion, for stability, because even Enbridge, which has kind of third-party exposure to the oil and gas sector through pipelines, this thing has not been following the energy prices because when oil sold off in the last week, all of the US oil plays sold off with it. But this guy, I'm still green on it, and I was buying it near all-time highs here, guys. This thing is so stable, it is nuts to me. In the last year, you see these massive mood swings, but they're really not that massive, at most 10% mood swings. And I mean, even on the average day, I mean, it literally usually drops like 3 to 4%. So this has been a great place to capture an amazing yield. Whether I overpaid for it or not, time's going to tell here, but I did buy it up here. So we'll see. I'll update you guys tomorrow on the exact buy price. But anyways, talking about the Shanghai index, guys, outside of the Canadian market being a place of solidarity, the Shanghai composite has been the exact opposite. I mean, this thing has been brutalized. In the year to date, it looks like it's only down 11.4%. Not that bad, but if we go zoom out the year, we're down like 30%, obviously in a full-blown bear market. But thanks to the Chinese Communist Party saying, look, we want to be rich. We want to be almost capitalistic to some degree with communistic characters, as Charlie Munger would say. They're starting to obviously offer some benefits to their stock market, guys. They're doing what the Federal Reserve did in March of 2020 when the crash happened. They're like, hey, we need to put our foot in here, fix out some of the regulatory issues, and just start getting this thing back up. And people took that to the moon with Chinese stocks. Not only did the index bump up, 4.9% in a single day, Alibaba, oh my God, when you zoom out and look at the full chart, guys, you don't even see this 30% blimp to the upside that happened down here. But we are literally trading back to its IPO price now that the company's generating like 10 times the revenue it was when it IPO'd. But just take a look at the last 5 days here, because on that long chart, you wouldn't even see this massive bump, right? So yeah, I really feel like Baba's caught a bottom, and I've called this. I said, look, at $75 a share, now that the rhetoric is changing, I think we're at a bottom here. And considering we've got Kevin O'Leary, Charlie Munger, Ray Dalio, we're going to see a huge media push for people to be buying into these at the current values because they are way cheaper than Shopify and the rest of the market, in my humble opinion. So I figured this would be a time to take a stab at it because I feel, from my gut feeling, I don't feel the gut feeling with Shopify yet, but I definitely feel it with Alibaba, that it's time to buy. And I look at a lot of technical traders being like, oh, the next bottom's at $50 to $60 a share because that's where the last base was. But I honestly think if this thing holds under $100 for much more than the next few months, I would be utterly shocked. And like I said, I picked up an average buy price. I bought more today at around $98 a share, and I was buying some at $89 a share. My average cost right now around $93 a share. And as I mentioned, guys, sometimes you're better off waiting to get these better price actions available to you, because in this downtrend that you knew the trend would be your friend, so why buy into a falling knife? I mean, it's paid off well for me at this point. I've got a way better cost average than any YouTuber I know, whether Everything Money's average cost on Baba is like 150 a share. Charlie Munger's I think is closer to like the 180, 200 range. Like my average cost is the low 90s. So I feel like I made a good decision on that. But look at the general Chinese stocks like Tencent, right? Tencent has bounced back 30% here. And I feel like if you wanted some foreign exposure, which is something I lack currently in my portfolio, I think this is your opportunity, not financial advice. So kind of coming back to this full circle of where's the market going from here? Have we hit a bottom? And honestly, from a Federal Reserve standpoint, so long as we don't see inflation continue to get out of control, so long as Putin doesn't drop some kind of chemical weapon or cause some kind of crazy World War III, and presuming assuming China's not partnering with Russia, which there's still a lot of concerns about, I honestly think, and again, those are some big concerns, if we can graze through it from here, guys, I can't see how the markets don't go higher and we start seeing bottoms. However, we're still in the eye of a storm. Now, coming out of the eye of the storm, nobody knows. Is it going to be filled with whirlwinds and tornadoes? Don't know. Is it just going to be mild winds and some further volatility to the upside? Nobody knows. So I'm not going to gamble on that like some people would. I am just playing the trends and just trying to adjust my weightings appropriately, which brings me to the conversation of why I'm done buying stocks. I'm getting to a point where I've mentioned, I feel like Meet Kevin, where I'm ADHD about what I'm buying, what I'm selling. I've been trading in and out of things like the S&P 500 index. I bought it, I've sold it, I bought it, I've sold it, thinking that I might be better off in some individual plays, thinking, maybe I'm better off in the index, and I'm tired of this angel and devil on my shoulder. So basically, I've got all the cash that I'm willing to get into the market. I'm literally leaving about 10,000 aside for an emergency fund that I'm never going to touch. And at this point, I'm just going to take a breath back from buying stocks. I'm just going to let my dividends build up a little bit, watch how Q1 earnings go from here, and I'll probably start buying back in closer toward the summer. And again, this is coming from somebody that has over $370,000 in the market, who's been buying aggressively into a bunch of different asset classes and moving things around. So if you're new to the market, keep cost averaging in. But for me personally, I just need to relax and stop being ADHD, because like I said, I'm tired of the bank getting rich. And again, it's boded well. I mean, like I said, I'm a few points off from all-time highs here, so I'm kind of blown away by that. So clearly, what I've been doing has been working to some extent, but it's never guaranteed. And obviously, as this unfolds, I will continue to update you here. So if you guys want to see how my portfolio evolves, if I made the right or wrong decisions, consider hitting that subscribe button, because God knows if BABA drops back down to $70 a share, I'm never going to hear the end of it. But stay cool, stay awesome, folks, and I look forward to catching you in the next one.